welcome. If you have not seen me before, my name is Samantha and I'm in client services here at the Retirement Group, and I moderate these weekly webinars. Today, we're going to be speaking to Chevron employees. If you are here, you are likely debating between taking the Chevron lump sum or the annuity. Luckily for you, we have our Chevron focused advisor, Tyson Mavar, here today, who's going to go over this decision with you and highlight some key factors to help you navigate this critical choice. Before I bring Tyson on, however, I'd just like to remind you that although TRG's advisors have a very intimate knowledge of Chevron's retirement plans, we are not affiliated nor endorsed whatsoever by Chevron. We are a completely independent group of financial advisors. And after Tyson's presentation, I'll be coming back on with him to ask him any of the questions you may have entered into the Q&A box throughout his presentation. Please feel free to ask away. We love answering your questions and engaging with you throughout the webinar. It's completely anonymous, so you don't have to worry about that. And with that, I'd like to introduce you to our speaker today, Tyson Mavar. Hey, Tyson.
Hi, Sam. Thank you, folks, for attending our webinar series today. My name is Tyson Mavar, one of the Chevron-focused retirement advisors for the Retirement Group here in Texas. And on today's webinar series, we're going to cover the Chevron pension plan, specifically the options that you have when you leave the company on how to take your pension, the lump sum versus the various annuity options. Those of you who aren't as familiar with our company, the Retirement Group is an independent group of advisors across the country that specialize in helping corporate employees plan for and transition into retirement. We manage retirement assets for employees from a variety of different companies around the country, and Chevron happens to be one of the companies that I have many clients from and have helped people through their retirement planning process and the decision-making process when you're transitioning out of Chevron. We have many complimentary services we encourage you to take advantage of, especially if you have not done so yet. The financial analysis, specifically the cash flow analysis, I feel is the most valuable of these complimentary services that we offer to folks that are approaching their retirement and transition from Chevron. We also can run an NUA analysis for your Chevron ESOP stock to see if there's any tax savings opportunity there, Social Security analysis, as well as an asset allocation analysis. If you just like our suggestions on how you're allocated in your 401k leading up to retirement, we're delighted to give you our advice on that as well. Also, this QR code here will take you to our LinkedIn page where we publish these webinars so that you can look at different topics that might be of interest to you specific to the Chevron plans, as well as just generic retirement income planning and investment planning. Now, when we're talking about the Chevron annuity, there's many different elements to the Chevron pension plan, and they harmonize the plans to where now there is, in the big picture, a defined benefit plan where anybody who started their career, whether it's Chevron, Texaco, Getty, Gulf, Caltex, Unical, any of the heritage companies, you will be on one of these defined benefit plans, which actually happen to be more lucrative or more valuable pension plans. If you started your career prior to 2008. If you started your career after 2008, you will be assigned the cash balance pension plan, just a different type of pension that grows more like a 401k, wherein the company has a balance of money assigned to you and your pension that grows as a result of interest credits over time, as well as salary credits the longer you continue working at the company. Now, all of these plans, the normal retirement age is age 65. And for the defined benefit plans, at least for folks that started prior to 2008, your default payment option is going to be a lifetime annuity. And there's actually a formula in each one of these different plans. Texaco is different than Gulf, which is different than Chevron. They have different elements to the plan that are going to have your pension growing differently depending on where you started your career. But all of them are similar in that the formula equates to a lifetime annuity, which can then be converted into a joint annuity, one of the various other annuity options, and also a lump sum, which has been very attractive for a number of years for many of our clients, but also some considerations for not taking the lump sum that we're going to talk a little bit about today. Now, if you retire prior to age 65, you can actually wait to take your pension. And there's a number of reasons you might consider doing that, whether it's because of age penalties, whether it's because you're taking the lump sum and anticipate rates will drop and therefore your lump sum will go up in value. You may want to look at that. If you retire after age 65, your commencement date will be directly after your retirement date. You don't have that option to defer. And in most cases, it doesn't make sense to do so anyway. Now, the lump sum, like I've mentioned, has been very attractive, although many of you have watched interest rates go up this last year to year and a half. And if you've been running projections on your pension, have also been watching your lump sum go down to a considerable degree for many folks. Now, the lump sum is not the only option. Fortunately, there's a variety of lifetime payment options, specifically the single life annuity, a lifetime monthly payment for you only, you, the employee or retiree, the joint survivor annuity, a lifetime payment for you and one other person, typically a spouse, but does not have to be. And there are several ways you can take that annuity option. For instance, by taking a reduced payout during your lifetime to increase the payout for your spouse or for your joint annuitant's lifetime after you pass. And there is also a couple of other options, a period certain option where it's similar to the single life annuity. However, there's a death benefit that's similar to term life insurance, wherein if you die in a certain period of time, there's some death benefit payable to whoever your beneficiary was on that plan. And there's also a Social Security leveling income, wherein you get less money in early retirement and then more money after you start taking Social Security. Flip that, more money in early retirement and less money after you start taking Social Security in an effort to level the income stream. Although I will tell you, I have never known, in the probably thousands of people I've talked to at Chevron, never known anybody that elected that option. Typically because most people will use their 401k to supplement their income prior to qualifying for Social Security if there is a gap in the income that they need. But an option maybe for somebody that did not save at all in their 401k plan or does not have assets and have a little bit of a shortfall in income as they approach Social Security claiming age. Now, single life annuity, it's fixed. This is one of the detriments of all of the annuity options, is that there is no cost of living increases over time, meaning that what you get now, you'll be still getting in 30 years if you're still alive in 30 years. And while prices go up over time, and we anticipate that will continue, cost of living will increase. Unfortunately, the true value of what your annuity will purchase will decrease over time, being that it's fixed. This is for the lifetime of you only. So another risk of the single life annuity is that you do not live a normal or long life, and the company keeps what they did not pay you or what you have otherwise been able to take as a lump sum and bequeath to a beneficiary, spouse, family, a cause that's important to you. So the life expectancy, there is a risk there on all of these annuity options. But what I see is people being attracted to the annuity is because of the hedge against longevity risk, the hedge against the risk of you living a long life. There's also makes some decisions a bit easier. You do not have to figure out how to invest at least this portion of your money. If you take the annuity, the company invests it for you. They are obligated to pay this to you until, of course, you pass away or until they default on the obligation in the event of insolvency. If the company goes into bankruptcy, then these annuity obligations get shifted over to an institution called the Pension Benefit Guaranty Corporation, or PBGC. So there is some insurance on this. The Chevron pension fund is still well funded, but who knows where any company will be in 20 to 30 years, and something that I've heard as a concern to some people that I've talked to that took the lump sum. The joint and survivor annuity, I will say that folks that are interested in lifetime income, this is typically the option they take, usually if they're married. Now, there is less money coming to you and your household in the early years of retirement because this pension benefit option is for 2 lifetimes. And of course, the life expectancy of 2 individuals is longer than 1 individual. So to compensate or offset for that, Chevron will give you less money during your lifetime in an effort to offer some insurance for your spouse or maybe some other family member, some non-spouse beneficiary, you also still have that option. And there's a range of different options that you can choose in terms of how much money you give your spouse or your joint annuitant. For instance, the 100% joint survivor is going to produce the least amount of income for your lifetime, and I should say your lifetime together, but it will have no change in the amount of income your joint annuitant will continue receiving beyond your demise. For example, the other option that we see is very common is the 50% joint survivor, wherein when you, the employee or retiree, pass away, there is a discount of 50% to what your joint annuitant or spouse will be receiving. But that option allows you to get a lot more income during your lifetime together. Everybody's different in terms of whether or not their spouse had benefits. That's a big consideration. What other assets you have other than your pension plan, whether or not you plan to work after you leave Chevron, your tax bracket status, your risk tolerance. There's many other variables in this. So we encourage everybody to look at multiple options, talk to us or somebody that you feel is well-versed in these different options, the merits in all of them, and run a cash flow analysis to compare different options so you can see, given some certain assumptions, of course, we have to make assumptions about the future, but given certain assumptions, typically very conservative assumptions, what's likely going to give me and my family the best bang for our buck with an uncertain future about, of course, life expectancy and how well the markets and the economy will do during your retirement. If we can make some conservative assumptions, typically we can whittle down the various options you have into the ones that we feel are most capable of meeting your objectives and producing a successful and high probability of success in retirement. Now, here's I'll zoom in this table here. We have a table of the interest rates over time that affect your lump sum. Many of you know that when interest rates go up, the lump sum goes down for everybody that's on one of the defined benefit pensions at Chevron. I mentioned earlier that anybody hired after 2008 is not on a defined benefit plan. They're on a defined contribution plan, or what's called a cash balance pension. These interest rates do not apply to the cash balance folks. If you were hired prior to 2008, regardless of which heritage company you came from, your Chevron lump sum is calculated based on your life expectancy as well as current interest rates. And these rates that they use are based on corporate bond, or what is also called the segment rates. So we'll look at the white rows here, June, May, and April. The most recent data that's available for the last 3 months. The first, second, and third segment rate are based on short, intermediate, and long-term corporate bonds, respectively. Typically, the shorter-term bonds pay lower interest rates, but right now we're in an event where we have an inverted yield curve where longer-term debt, longer-term bonds actually are paying less interest, have smaller interest rates. So all the rates are right about the same, but if you look back all the way down, going to, I think we go as far back as January of 2023, you can see, interestingly enough, the shorter term interest rates were lower than the intermediate term interest rates. Something else to keep in mind about these rates is that the second segment rate carries by far the most weight in this calculation. So that's the one that we follow the closest. For example, the second segment rate accounts for about 60% of this calculation, whereas the first segment rate accounts for only about 20% of the calculation. And the third segment rate is close to 20%, although it could be less or more depending on your life expectancy when you take the pension. Something else to consider is that the older you are, the less the company has to give you as a lump sum because your life expectancy is shorter. This is one reason that we see many employees seeing their lump sum actually decline when they get up to a certain age, so usually somewhere around your mid to late 60s, even if you're still working at the company. And that's not only because interest rates could have been going up during that time frame. Even if interest rates were flat, we could see people sometimes losing money on their lump sum, because even though the company is still adding money based on the person continuing to work at the company, the actuarial tables might equate to a smaller lump sum because the life expectancy is getting exponentially shorter as we get older in our career. So let's talk about these rates. It's not important for you to memorize these rates. And it's also helpful that the company has a great modeling tool through the benefits website where you can plug in different retirement dates, and you can also plug in different assumptions about what direction interest rates go to project what your lump sum will be given different circumstances. What has happened is that rates have really climbed in the last right about a year and a half, just over a year and a half, to where lump sums have gone down for many of our clients and prospective clients to the tune of somewhere around 30%. In some cases, even more than 30%, just in the last year and a half. You can see that below June, May, and April, we have the September blended rates. That is the average of the three rates above. The reason this is relevant is because Chevron takes the interest rates for the third, fourth, and fifth month prior to the month that you commence your benefit, and they'll take an average of those rates. And those are the rates that they will blend together to calculate your lump sum. Why this is significant is because it gives us a bit of a crystal ball in terms of what direction interest rates are going, and therefore what direction our lump sum is going. And this helps us to make good decisions on the timing of our retirement and or the timing of the commencement of our pension benefit. If we expect interest rates to go up and our lump sum to go down, we may pick a different retirement date or commencement date on our pension to save some money on our lump sum. Or in the example of a declining interest rate environment, we may defer the election of our pension so that we can continue to watch that increase until we see these rates bottom out. And then once they start going up again, that's probably when we would decide to commence our benefit to avoid losing money on the lump sum, and also to gain access to that money in an effort to invest it and earn interest, whether it's in stocks, bonds, CDs, money market. The opportunity cost of leaving money in the pension is whatever interest rate we assume that money would be able to earn outside of the pension. So some moving parts here. This is a conversation we have with our clients that are both approaching retirement and also the ones who left the company but strategically elected to leave their pension where it was for one of two reasons: age penalties or what's happening with interest rates. Now, like I mentioned earlier, the lump sum has been very attractive for a long time, although the payouts are a lot lower today than they were a year and a half, 2 years ago. The silver lining on that is that you can earn a lot more interest today in safe asset classes like bonds, CDs, money market, or fixed income investments. Even annuities that exist outside of the company, from insurance companies, for instance, are paying higher withdrawal rates on their lifetime annuity payments, and also have, in most cases, higher cap rates and higher crediting rates for their annuities. So even though the lump sum payouts are lower, the alternatives to the annuity, as far as investments go, are more attractive now than they were in the last couple of years. Now, I haven't seen too big of a change in terms of the percentage of people that I see taking an annuity versus a lump sum as a result of this. There's many other factors that I see people choosing to take a lump sum other than just what the payouts are on the lump sum. Some of those include the death benefit, the flexibility of the death benefit on the lump sum. You can leave pension money through your lump sum to children, grandchildren, causes that are important to you, your church, your college, your charity of choice, better by taking the lump sum than you can with the annuity options. There are some different death benefit options in a couple of the annuity options, like the joint survivor. You can add a lifetime annuitant on. The period certain option, you can add a partial lump sum death benefit, assuming that you don't live a long life. So there is some death benefit options, but the lump sum has the most flexible death benefit option. And certainly if you were expecting a short life expectancy, or if this was really, really important to you to be able to leave money to your kids in case you didn't live a long life, or to somebody other than a spouse in the form of a lifetime annuity, this could be an option that you might consider. Also have clients that expect they will be able to invest the money and do better than the income payouts that the annuity would produce. Although, of course, there's risk to that. If you do not manage the investments appropriately, not only could they lose value, but you also have to be able to manage the income payments. And I have certainly spoken to people that, whether it was my opinion or even their own opinion, may not be the best fit for a lump sum because they just don't have the discipline to not overspend and keep that as a sustainable plan for the rest of their life. So there's definitely some risk with the lump sum. There's definitely some attractive features that some people, but not all people, are attracted to. And my opinion is that everybody should look at several options, compare the lump sum versus the annuity, run some projections on both, talk to a professional that does this on a daily basis about the merits. And after understanding your values, your risk tolerance, your objectives, a little bit about your family, oftentimes it's easier to identify what's likely going to be the best option for you and your family given an uncertain future. Now, I hear questions all the time from people on why, when interest rates go up, does my lump sum go down? And we've actually created a slide that equates this to a mortgage payment. Imagine that you were able to get a mortgage today. Let's say your budget was $19.50 per month. You were going to move in retirement. Current interest rates, let's say, of course, we can't do this now. There are very few people could get a 4% mortgage now that interest rates have come up as high as they have. Well, let's assume today you could get a 4% mortgage for a 30-year fixed. The bank or lender tells you that you can buy a house. You have a spending budget of about $408,000, $408,500. Now, let's say you wait 6 months to make that decision. You go back to the lender. Nothing has changed to your monthly budget on how much you can afford to the house or for the house, but interest rates have gone down from 4% to 3%. Now the lender is telling you you can actually afford a house that's $462,000 or $462,500. This is very similar to what's happening with the present value calculation on your lump sum pension for the defined benefit plans. Again, this is not for the cash balance plans. The cash balance plan, what you see is what you get. That actually equates to a lump sum, and interest rates do not affect the lump sum. Interest rates actually, when they go up, help the crediting method of the cash balance plan. So higher interest rates are actually good for that plan. But for the defined benefit plans, this is why higher interest rates will reduce the lump sum, effectively because you could go invest that money and generate more income. So the company figures to make you indifferent between the lump sum and the annuity, assuming you live to a certain life expectancy. They give you less money in a higher interest rate environment and more money in a lower interest rate environment to offset for what you'll be able to invest that money at, depending on those corporate bond interest rates. Now, what we found at the retirement group statistically is that 74% of Americans do not have a written plan for their retirement. And we feel that there is no excuse for this because there are a variety of companies, including ours, that will do this for you on a complimentary basis. If nothing else, this will help you verify that you are on track for a successful retirement. You may actually uncover some problems in your plan. You may uncover some things that you didn't consider that would actually improve the probability of success in the plan, whether it's alternative investments available to you, even while you're still working, alternative thoughts and considerations on the pension options, benefits that you may not have been taking advantage of, tax strategies that you may not have been taking advantage of, both while you're working, through your transition from the company, and after you leave the company. This is the most common aspect that we identify when we run the cash flow analysis are tax efficiency issues. Things like net unrealized appreciation that exists in your Chevron ESOP stock is a pretty common one. Things like Roth conversions. There could be some estate planning considerations that you might have overlooked. All of these reasons, we encourage you to call us, have us run this cash flow analysis. Even if you already have, we try to update these annually for folks. And even if you're not yet a client, this is a great way for you to get to know us and us to get to know you, to see if it might be a good fit to work with us when you retire from the company. We also encourage people to do a test run of our services before you retire. If we you think it might be a good fit to work with us, we'd encourage you to do some business with us prior to retirement with a smaller amount of money to confirm that it is indeed a good fit. If the performance on the investments is great, if the fees are reasonable, if the customer service is great, if the advice was good, if the relationship was good, those are all boxes you might want to check prior to choosing an advisory firm and handing over what might be all of your life savings at the point that you leave Chevron one day. So if you'd like to get in touch with us, whether it's to have us run the cash flow analysis, talk about your 401k options, or you just want to ask some questions, you can email us at info@theretirementgroup.com. You can call us at the home office at 800-900-5867. You could take a picture of this QR code here, and it'll take you to a place where you could schedule a meeting directly with myself or one of my colleagues at the company. And here again is that LinkedIn page QR code where you can follow along with content related to the Chevron benefits, as well as generic retirement planning strategies that we found were very helpful for folks in a similar situation as yourself. That was all the content we had to cover today, but I believe, Sam, we have still some time for questions. So if there were any questions that came up, I'm going to let you bring those up and we'll do our best to answer those.
Yeah, we're going to try to get to as many as we can. The first one is, with higher rates than last year, does the Chevron annuity make more sense?
Good question. Maybe. And there's a lot more to it than just, what's the payout today versus yesterday. For some people, they might even be more attracted to the lump sum today, like I mentioned, because interest rates are higher. So, CDs, many of them are paying more than 5% in some cases per year in a very, very low risk environment. Annuity payouts are a little bit better. So while the payouts are lower, the value of the lump sum dollar for dollar is higher based on what you can purchase with it in terms of investments. But there's much more to it than even that. And it has to do with, your values in retirement. Who do you care about are obligated to take care of in retirement? Are you married? Do you have children? What's your risk tolerance? Somebody who is a lower risk tolerance might be more attracted to the annuity. Somebody who is not comfortable having money in stocks is probably going to be a better candidate for the annuity than somebody who's comfortable having 50, 60, 70% of their retirement portfolio still in stocks, because they're going to generate a higher return on average, and it's going to have that lump sum money lasting longer. Or what I think of as the break-even point, and we make an assumption about what interest you'll be able to earn on your money. There's going to be a break-even age to where the annuity made more sense if you lived longer than that age, and the lump sum made more sense if you didn't live to that age. That's a pretty helpful number to know, or age to be aware of. And we have to run a cash flow analysis to identify that, as well as some of the other factors on what's going to be the best option for you and your family, the lump sum or the annuity.
Thank you. Next one. With higher interest rates and increase in Social Security, how will the Social Security offset affect my pension?
That's a very, very good question. We didn't talk about the Social Security offset in today's webinar series, but some of you might know this is something I and my colleagues that specialize in the plans at Chevron and the other companies that we work with have to read a document called a summary plan description for the pension plan to be able to guide people and understand the different rules and different aspects of the decisions. There's a part of the pension formula called a Social Security offset, wherein the company will actually reduce your pension, both the lump sum and all the annuity options, by a percentage of your projected Social Security benefit at age 65. This is a detriment to the plan, of course, and it's important that you understand age 65 because there's a factor on your pension projections called the Social Security age 65 PIA, or primary insurance amount. This is what the company is using to reduce your pension. Something else that's important to know is that they don't always get that number right, and you can prove them wrong if it is to your benefit. But I will tell you that you want to make sure it's going to benefit you before you send in your Social Security statement, because they will fix it even if it's not in your favor. So this is something we work with our clients that are retiring to see if that we can add some money to their lump sum or annuity payout. For instance, I have a client in West Texas that got an extra $32,000 on his lump sum when we turned in his statement. That's real money. That's worth the evaluation. Or another individual who got an extra $200 a month on her, she took a joint 50% survivor. Her pension was $200 a month more because we told her to turn in her statement and they corrected the mistake. Although it could have worked the opposite way too. So we'd want to know about that and not tell the company about it if that was the case. But the question was, everybody has gotten increases to their Social Security, whether or not you are collecting yet, because inflation was so high last year. In January, most folks got close to a 9% increase on their Social Security benefits. That also means your projected Social Security benefit is higher, which is going to produce a bigger offset and a lower pension payout, unfortunately. Now, there's nothing we can do about the higher payouts, although this needs to be considered when we're planning for how much money do we need in retirement and where is that money coming from. It's possible you could see a reduction in your annuity payment. Although if you're still working, your pension is still growing, your projected monthly income from the annuity is going to go up every month you continue working for the company. It's going to also go up if you get raises, because that's another factor in your pension formula. Although the lump sum could be going down like we saw because of life expectancy, and that needs to be looked at as well. Best advice I have is to run pension projections often, probably no more often than monthly, because that's how often they update the interest rates. And look at future retirement dates, look at a year out, 2 years out, look at your ideal retirement date, look at the worst case scenario. I've heard a lot of people think that, it seems like I've worked for the retirement group and worked with Chevron employees for about 11 or 12 years now. And it seems like every 2 or 3 years, the company will do some type of reduction in force or right sizing or offer employees to leave payroll. And Chevron's actually been one of the more generous companies to pay what last time was a full year's salary to employees that were close to retirement anyway. So that could be something that we're seeing, and it's always good to be ready for those offers to leave the company. So run your cash flow analysis as if you were retiring this year. I think there's no harm in doing that. And then compare that to if you leave the company at your ideal retirement date sometime in the future, and then start preparing for not only different retirement dates, but different payout options. And then also factoring in, like Sam asked about, Social Security. How does that play a role not only as a benefit to my income in retirement, but as a cost to my pension benefit? And what can I do to maybe increase potentially my pension benefit by being aware of this factor in the pension formula? Great question, whoever asked that question.
Yeah, it was a great question. Thanks, Tyson. I think we have time for 2 more.
Okay.
So this third one, if Chevron decides to change the lump sum options terms, how much notice am I entitled to, and what alternatives do I have?
That's a good question. If they change the terms on the lump sum, so I think the basis of this question was take away the lump sum, or maybe take away part of the lump sum. We've seen that some companies do that, which is actually so some companies are forced to do that because their pension funding is suffering. They're not allowed legally to pay a full lump sum because the fund can't afford it. I'm not concerned about that with Chevron, but again, there's no telling what the future will bring. I am not certain about, I'm not certain if the company is required to give you any timing on that. Although in my experience working with people that had that rug pulled out from them, there was a timing, I think it was maybe about 1 or 2 months, where it's basically the lump sum option is going away. And typically when the benefits are changed, that happens anyway, to give people some time to do some due diligence and maybe consider leaving the company and taking the pension as a lump sum in this scenario. But to be honest with you, I am not sure if they are required by law to give you any timing on making that decision. And I think there was a second part to that question, Sam, other than just the time that they are required to give.
What alternatives would I have?
What alternatives? Yeah. The alternative, of course, would be the annuity. It would all be a case-by-case basis on what the company decided to do. But the only instance I can see, I don't expect that Chevron would do that other than being required to because the pension fund was insolvent or suffering. It seems that the companies are actually preferring people take a lump sum, especially in this higher interest rate environment, because the payouts are lower. and also to get the liabilities off the books, because on average, people are living longer, and Wall Street and investors don't like uncertain liabilities. So by reducing the amount of uncertain liabilities, which is what paying a lump sum to people does, they've actually met a good objective. And we've actually seen people offered a lump sum after they took an annuity, or if they retired and hadn't elected to take their pension yet, and maybe didn't qualify for a lump sum. We've seen Chevron and other companies come back and say, well, we're going to offer you a lump sum because we would actually prefer to get you and other liabilities off the books. No telling what the future holds, but it would have to be evaluated on a case-by-case basis, I think.
Alrighty. We're going to take one more. I encourage you guys to click the link after this webinar has ended. You'll be redirected to a contact page where you can book an appointment with Tyson. If your questions were not answered today, I apologize. Tyson, last one. Is there a way to ensure that my annuity from Chevron is protected against potential company insolvency or other financial risks?
Yeah, I mean, we talked a little bit about PBGC, Pension Benefit Guaranty Corporation. There already is federal insurance if in the instance that Chevron were to be insolvent or be in bankruptcy filing. We've seen that happen to big companies in the past. Sears Roebuck was a very big company long ago that their retirees that took the pension annuity, they're no longer getting their pension from Sears, which is in bankruptcy. They're getting it from PBGC. Some of the airlines and the auto industry companies have also done the same thing. I talked to an individual who worked at Delta not too long ago, who he's a pilot and his pension is coming from PBGC. Usually when that happens, there's a reduction in the payout. So a lot of people don't get what they expected to get. They have a reduced benefit, which is obviously not ideal when you expected this money to come in. But there's a bit of a backstop. And, of course, taking the lump sum, now you control that money. You can, like I mentioned earlier, we use Charles Schwab as a custodian. That's where our clients keep their money if they decide to work with us in retirement. But you can, once you take the lump sum, you can move that money to Schwab or Fidelity or Vanguard or a number of insurance companies that might be a safer bet than Chevron as a company, or they have additional insurances that Chevron does not. So really taking the lump sum, I think, is, if that's something you're concerned about, really all you can do other than having the backstop of PBGC already in place on that annuity that you will one day be taking from Chevron.
All righty, Tyson, that's it for today. Did you want to?
That's all I've got today, Sam. Thanks so much for the help today. If you, like Sam mentioned, if you have any interest in meeting with me or any of my colleagues, let us know, even if it's just for a couple questions. But we appreciate the time today, and we hope to talk to you all very soon.
Thank you. Thanks, Tyson.